Hi there, and welcome to this webinar. Thank you for joining us today, and great to have you with us. My name is Sonia Dunlop. I'm the CEO of the Global Solar Council. We are the World Solar PV Industry Association. I am based in London, previously worked for Solar Power Europe in Brussels and Solar Energy UK in London. And it's great to have you with us for this webinar about 2024 in review and 2025 in focus, the outlook with European renewables leaders. This webinar is a precursor for an upcoming event next February in the new year, Solar Finance and Investment Europe, which is going to be held in London on the 4th and 5th of February of 2025, organized by Solar Media, who I'm sure you already know and have also organized this webinar. We're going to be talking over the next hour with our fantastic panelists about what are the challenges, the outlook, and what the landscape looks like in terms of financing utility scale and large commercial rooftop solar PV and storage across the whole of Europe. So that's not just the EU, but all the other wider markets as well. And if you want to find out more, obviously, please do come along to the actual real life event, Solar Finance Investment Europe, where we'll have not just 1 hour of analysis for you, but over 20 hours in total of content and analysis and networking opportunities for you to enjoy. So just be aware that we will also be having a Q&A session towards the end of this 1 hour webinar. So if you have any questions for any of the panelists or any questions in general, feel free to put them in the Q&A box. That's the Q&A function, and we will try and make sure that they are answered by the relevant speakers. And just to say a few words of global context before I introduce our panelists, and we have some fantastic people speaking today from Quinbrook, from NTR, from Infrared, from Santander, and from Lightsource BP. But just as a bit of context, this year, 2024, another record year for solar worldwide, 600 gigawatts of installed capacity across the year globally. And we have now reached the massive milestone of 2 terawatts of total installed capacity, cumulative capacity worldwide as well. Reached that just a few months ago. So it's really been a big year. And indeed, as the International Energy Agency has estimated, the world has invested $500 billion into solar this year. Absolutely huge figures. And we know that, roughly speaking, it's not an exact science, but we think about 80% of the world's utility scale solar finance is being channeled through London as the world's premier financial centre, through the City of London at one stage or another. So we know that Europe is in many ways the epicenter of the global financial scene in terms of utility scale solar, and also a really important market itself as well. We know that there are, however, massive challenges in terms of the financial environment, higher interest rates, and challenges in terms of delivery. And certainly we, as the Global Solar PV Industry Association, representing all parts of the world, know that the cost of finance is really important for markets all over the world. And we have created the International Solar Finance Group as a way of trying to address that, bringing together the solar industry representatives, our company members, our financial services members, and public and private banks from all over the world at global level, the leading investors in solar, to look to try and really overcome the challenges and bring down the cost of capital all over the world. We know that solar is an incredibly capital intensive technology. It was said at COP29 Baku, this is about as capital intensive as it gets. And so we really know that we need to be making the case for this to be considered a really strategic technology, absolutely critical to the competitiveness of economies going forward, and macro critical as well going forwards for countries around the world and across Europe. Here in this webinar, we're really going to be looking at utility scale, big commercial rooftops, and Europe in particular, and covering a number of different themes. So I'd like to turn, if possible, first to Ruth Lai, who is Senior Vice President, Vice President at Infrared Capital Partners, based in London, managing both public and private funds, to give us a bit of an introduction to what you do at Infrared, but also to tell us a bit about what you see in terms of the current higher interest rate environment and how that's supporting efforts to raise finance for solar projects across Europe. Ruth, over to you.
Thank you, Sonia. Very glad to be here. I am a VP at InfraRed. InfraRed is a London-based investment manager, manage a few different funds, both private and public, that can be deployed into renewable energy, for example, solar. And as Sonia mentioned, yes, indeed, the challenge that we have seen this year in particular compared to all the past years is the higher cost of capital. And when we see the higher cost of capital, that's the higher cost of equity and higher cost of debt. And in particular, if we look at solar as a technology class, it's getting increasingly difficult to be able to generate the required cost of equity from operational solar. And therefore, as you have seen, which is quite a common trend in industry, that a lot of the investment managers that belongs to what we call income strategy increasingly expand exposure to development. However, and the development comes from a few different ways. One is to invest directly into a development pipeline, and then the other common way is to, rather than do direct asset investment, invest into a development platform, so that you have a bit of both. You have the mix of the operational existing generation fleet, and you also have the growth coming from the development pipeline.
And when you say the challenges in terms of getting returns from operational assets, can you break that down in terms of the different markets across Europe and why that is exactly?
Yes, indeed. So I would say that if you think about the project level return, the levers are still the same. So for example, you have the revenue, you have the cost, you have the capex, and you have the development before the asset is generating a yield or cash flow. So if you compare this year's merchant power price against last year's, you will see the merchant power price has across European markets been lower. And that's also why increasingly a lot of projects start to increasingly actively participate in the PPA market. And especially, for example, when we look at solar, we look at predominantly UK and also in Spain. So if we just look at the power price element of the project valuation, you see in Spain, I would say that 2 years ago, the PPA market is more nascent, in the sense that you see a lot of discount to merchant type of PPAs. And now increasingly you will see payers produce flat price PPAs, which is a symptom or a sign that the PPA market is more maturing. And you will also see the volume has been increasing, which of course facilitate the placement of project finance.
Yeah. So those zero prices and those negative prices are starting to bite, and we need to respond. And obviously, one of those solutions is storage. Next, I'd like to go to Alex, if that's okay. Alex de Souza is General Counsel for Europe, Middle East, and Africa at Lightsource BP, one of the world's leading global solar and storage developers around the world. It'd be really good, Alex, if you can tell us a bit about what you do in the business, but also about what you're seeing in terms of the challenges of delivering utility scale solar and storage across the whole of Europe. I know you're active in many different markets, and what you think we need to fix in order to make that financing part of the sort of task easier in years to come. Alex, over to you.
Thanks, Sonia, and a pleasure to be here this morning. Hi, Alex de Souza. I'm General Counsel for EMEA. I cover the 10 markets in the European region that we're very active in at the moment. In terms of what we are seeing as key strategic challenges, and I'll look more broadly at Europe, not just at the UK. It's been interesting because I was asked this question very recently at sort of one of our management offsites about what did I think is sort of the existential threat to our business model. And I think I surprised everyone with my answer, because the common themes would be interest rates, PPA market, negative pricing. And I actually came at it from a slightly different angle, because what I'm seeing, with my legal hat on, is some of the challenges right at the start of the development process. And that I would say is the effects of not having proper community engagement right at the start of your development process. And why is that relevant for us at the finance side of things? I think it's incredibly important because obviously it's the relationships that we're going to have with community throughout the life of the project. But how do they impact us as investors? Impact us because of delay. Now, what I'm seeing is that not just in the UK, but in many markets, the professionalization, the awareness and the activism of community oppositions to projects which they don't think have been appropriately developed. And that has an immediate impact on all of us because of timelines. And it's something that we all have a responsibility to manage appropriately. And it's something I know most of the trade associations, most of the bodies across Europe are encouraging developers to look at more appropriately. But I think it's something that's not unique to the UK. We're seeing it in Spain, in Greece, in most of the markets. And it's something that with correct policy, correct engagement, and with appropriate sort of strategy, all of us can kind of look to contribute and manage better. Because it will, in fact, not only sort of the timelines of projects, but also if you look down the road, and as we've been discussing, most of our projects will have PPAs in place. We need to be able to accurately predict when we're going to hit COD. We're going to have LDs, we're going to have long stop dates. And we need these projects to manage through the appeal processes and have accuracies when they're going to hit COD. So that's one of them. The other one, I think, which a few people would touch on, is connections reform. And managing the grid, managing connections processes is a huge sort of process in place in the UK at the moment, which will impact most of the developers. And I think that's one that we all need to sort of spend a lot of time on.
Yeah, really interesting. And as you say, delays, whether it be grid or whether it be from a lack of community engagement, cost money. And this is obviously putting up the cost of development, which is increasing costs across the board. And so we need to really be thinking about how we can, country by country, strengthen the sort of political infrastructure and the public outreach infrastructure in order to sort of ameliorate this across the board, and of course establish best practice across the whole industry in terms of local community engagement. So that's really interesting to get your input there, including from markets like Greece, like Spain, and others where you're active. But talking of those issues in terms of getting those grid connections and then capturing those prices in the market, obviously battery storage is a huge potential solution. And Bart White from Santander, you're the head of energy structured finance at Santander Corporate and Investment Banking for Europe, Middle East, and Africa. It'd be really good to get your perspective in terms of what you're seeing in the market in terms of financing utility scale across the continent, and also what your perspective is on battery storage going forward, and how much of a role you think that's going to be playing in terms of standalone, co-located with solar, or indeed co-located with wind and solar, and yeah, what your analysis is on that. Bart, over to you.
Thank you. So, and thank you for inviting me to join the webinar. So I guess there's two parts to that question. There's generally what's happening in the market and with a financing perspective, but also narrowing down to battery storage. I think in terms of the market, this year has not been homogenous. There's been periods where it's been quite quiet with lower deal flow. The last 3 months have been hugely active, and actually going into 2025, we're seeing a huge amount of volume in our pipeline, but across the street, I know that there's a huge amount of deals which are being financed. So access to capital is still not a problem. If the ambition of capital is unrealistic, then it won't be accessible, but with reasonable aspirations in terms of cost of finance and leverage, there's huge abundance of capital available to finance new projects. So it's really just a question of how long a project's taking to get to the RTB stage and getting access to the debt financing. The projects are still of the same sort of size. We are seeing some larger portfolio transactions. We're seeing a development of an adjacent market around holdco, NAV, and DevEx type financing to support developers in different stages of their life cycle, which is very positive, I think, in terms of adding fuel to continue the build out of solar across Europe and across the world as well. Just narrowing down to battery storage. So there's been everything that has happened in battery storage is now going to get surpassed. Even perhaps only in 2025, we might surpass the volumes which have been achieved to date, just because there's huge numbers of new projects. And actually, these are very good projects, large projects, and they clearly play a very critical role as an adjacent technology to all of the renewables, which is being added to the grid at the same time. We've done, I believe, twice the number of deals as our nearest competitor in the battery storage space. So it's a big part of our business and a big part of our pipeline next year. It's not, each geography has its own dynamics, and a lot of attention is now being placed on Italy because of the Maxi next year. I think that's going to be a very exciting market. But batteries are relevant across Europe and across the geographies I cover. So yes, we'll see more deals. The technology for batteries, the financing technology, was sort of project finance 101. It was a relatively basic form of financing for the early battery deals. But if we continue to do deals and we continue to do larger deals, actually the financings are becoming more bespoke, dependent on the actual cash flows. A tolled battery and a fully merchant battery are completely different assets from a revenue perspective, and they should be financed in different ways. And so we're seeing that now come through in the next generation of deals. So we're structuring effectively cutting edge transactions to help facilitate not only just getting batteries built, but getting batteries built with the right equity return as well for the owners.
That's absolutely fascinating. Thanks. And so you're saying that Italy is the market to watch here. Are you finding what would you say are the other markets that either, are very active in terms of storage, or you think where there's this particular issue that needs to be fixed?
So I think I wouldn't say that there's any issue. Each market has its own maturity in terms of regulation to support additional batteries being added to the system. And of course, batteries are not the only form of energy storage. And so there's other technologies which are being explored in parallel, especially around long duration technology as well. We've been doing batteries in Italy, or at least we've got a big pipeline for Italy, Finland, France, Germany. We're looking in Spain, of course. We've done our first batteries now in Spain. UK's been the busiest market, and it was the earliest market, I think, in terms of large-scale adoption for batteries. But each of those markets has a lot of batteries which still need to be installed, including the UK. And we're working on a 1.45 gigawatt battery system as advisor at the moment. Fantastic plan, fantastic assets, very relevant for the grid. So I think, yes, the scale and the size and the opportunity just continues to expand.
Absolutely. And of course, in addition to increasing that both short duration battery storage capacity and the long duration storage capacity, we need to be thinking about how else we can build flexibility into these markets, into these systems, whether that be with more flexible demand, more electrification, more time of use pricing, more interconnectors, right? Flexibility is ultimately what we need in order to solve the grid integration challenge that we're seeing in many countries around the world. Anthony, if you don't mind, I'd like to come to you next. Anthony Doherty, you're Chief Investment Officer at NTR. You're based in Dublin, but you cover the whole of Europe, the US as well, in terms of solar, in terms of storage, in terms of offshore wind. I'm really keen to hear your thoughts in terms of how easy has it been to raise capital this year compared to maybe previously, and whether you're also experiencing issues around zero prices, negative prices, capture rates, and essentially in different markets, and whether you're finding that corporate PPA market is deep enough in order to maybe try and address some of that. Anthony, over to you.
Sure. Hi. So I'm with NTR. We're on the equity side, so probably more like Ruth, and very much we've been around 45 years, so close on 4 gigawatts. So we're, as Sonia mentioned, right across wind, solar, and storage. We're principally in terms of capital raising. It's, I suppose, if you look at what's happened in 2023, there was a big focus in terms of step up in discount rates with base rates going up. So investors' return requirements sort of got adjusted accordingly. I think the market now in 2024 has probably sort of stabilized, and we see this as well probably both in terms of on the project side as well, in terms of developer premia and flowing its way through the chain, where everyone now has sort of rebased back, and probably, as Bart said, in the second half of 2024, there's been a sort of a step up in activity levels. In the end of the day, and actually even now with interest rates starting to sort of tail off a little bit, or signs that the trend is going backwards, we are now starting to see that the discount rates have definitely stabilized. So they've stopped increasing, and in some cases, particularly on the operational side, they've maybe gone down. They're maybe dropping a little bit. So, and valuations in certain markets, where there's very highly contracted revenues. The one thing I would say, just in terms of it's all about risk and return, and that so 100% contracted contract for difference project is very different to a project which may be have 60% under a corporate PPA, and it is exactly as you say. Probably two things we're starting to see is constrained curtailment coming in certain markets, and then secondly is negative prices. On the constraint to curtailment piece, it's interesting if you look at some markets, if I take, Ireland, for example, in the contract for difference, so the res there, it is actually covers constraint curtailment. So it that's quite attractive from an investor perspective. And we ourselves have done corporate PPAs in Ireland in the past, but you know the attractiveness now of a contract for difference that covers constraint and curtailment, particularly in areas where that might be more of a question mark, is an important differentiator. So the corporate PPAs have to sort of take that into account, because again they are looking for green electrons. If you look at other markets in the likes of Spain in solar, where you know we are seeing probably a lot of sort of negative pricing. Again, the structure of your corporate PPA and allowing sort of to still export power when prices are negative down to a certain level is probably a point in corporate PPAs that maybe people weren't thinking about a couple of years ago, but now there's nothing worse than having to not export when maybe you could export for a period of time, either at zero pricing or into slightly negative pricing. So that's probably be a factor. But then stepping that aside, we are starting to see even ourselves to try. It's a bit back to what Ruth said. You know, we're being asked by our investors to get higher returns, and so you have to try and find projects where the risk-adjusted return is that little bit higher. And with the likes of constraint curtailment or negative pricing impacting on export, the use of storage, you know, whether that's a co-location, so they don't necessarily have to be DC coupled, but you could just have two revenue streams, just using that sort of grid connection costs better, or even just grid connections are harder to get now. They're so just maximizing the utilization of them is an area that we're doing both in Ireland and but then standalone as well. We're doing sort of storage in Finland as well, and looking at that very much so in the likes of France and Spain. So it is very much a market for market, trying to figure out how do you best maximize the return based on the risk profile. And so look, it's a constant, things constantly change. So you got to be constantly looking at what we're doing. The one final thing I would say is we are probably doing a lot more development side as well. So going earlier in the curve, working with partners to pretty much along the lines of what was got chat about earlier in the process around the community engagement piece, and just helping people professionalize that and increase the probability of success of getting their project to an RTB stage, and then taking that forward and financing and building it.
Yeah, which is exactly what Ruth was saying earlier, and really interesting what you said about thinking about how to make maximal use of grid connections, hybrid projects, obviously, solar and storage and wind. There's also a lot of an interesting work around floating solar on existing reservoirs on hydro dams. The grid connection is already there. Let's stick some floating solar on it and use it when we can. Indeed, there's even work going on at global level about, shall we just put solar on every gas and coal power plant around the world, use their grid connection in those nice sunny hours in the middle of the day with a bit of storage for the shoulders, and bring down their operating hours nicely around the world as well. But I wanted to come back to something you said, Anthony, about how solar had responded and how things had stabilized in terms of the discount rates and the expectations of your investors. You're active in both solar and wind. Would it be fair to say that solar has weathered the storm of the higher interest rate environment over the last year or two better than wind, because we have seen continuing declines in our fundamental input costs, particularly modules I'm thinking of. I would imagine inverters as well. And do you predict that will continue? So are you predicting that those module costs will continue to decline next year as well? And it'd be good to also after that get Alex's input on that as well.
Sure.
But over to you, Anthony.
So absolutely. In a European context, maybe first of all talking about wind, there has been a step up in price in OEM or turbine pricing, and so therefore that coupled with a step down in wholesale pricing has made a lot of, in the likes of the Nordics, it more difficult, where you have the levelized cost of energy has gone up and the available offtake has gone down to make projects work. So you've seen a sizable drop off in new capacity sort of additions, and that's exactly to say the likes of wind and solar in the Nordics is maybe gaining traction to try and just optimize things. It depends where we're seeing, and that's probably more the whole where we're seeing sort of contract for difference markets in the likes of Ireland and France and so on in wind. There still is a deal flow because the pricing's adjusted accordingly in terms of the offtake. But solar is yes, like the panel prices have decreased. The supply chain economics have got more favorable. So it has been able to flex and adjust to lower pricing overall, which has been great. And like I hope that continues. I think probably in the short term we're not seeing an increase. And it's very similar as well in batteries. We are seeing a downward trend in cell pricing, so which is very useful as well. Again, competition from China, and that it touches on a point maybe about the whole local supply chain side in Europe. It is a challenge, but that's a separate topic. But if from a Chinese perspective, there is a lot of capacity chasing, and who knows what's going to happen in tariffs and so on. But I think the baseline cost inputs we'd like to see is continuing on a trend downwards. Which so from a solar perspective, it is and also if on a political side, solar is probably a little bit in a better place in some markets than wind. So if I take, for instance, France, for example, with the success of the RN and the Marine Le Pen, and other non-centrist parties, they have more of a pro-nuclear, anti-wind sort of perspective, whereas solar is maybe viewed as not as maybe controversial. So it is, and particularly where people have made moves toward agrivoltaic solar, which has more of a let's say a local context. People are, it is probably harder to get you the same size and scale, but it's easier from a sort of a community acceptability and a planning acceptability perspective.
That's right. And we at the Global Solar Council are definitely planning some work in the next year or two to try and establish a global definition of agrivoltaics, of agri-PV, that is broad enough, a broad enough church to encompass all the different types of agrivoltaics, including grazing animals on the land around the solar. But no, that's really interesting, and really interesting to get your perspective in terms of the panel prices coming down. Alex de Souza from Lightsource BP. So it'd be good to get your perspective on what you think those input costs, those module prices are going to do next year. If you want to make a prediction on how big you think the European market, or indeed the EMEA region more widely, will be in terms of installed capacity for next year, but also to get your input on those different models that people are pursuing, such as agrivoltaics, and the corporate PPA market, and how you as a developer how easy are you finding it to find those corporate PPAs in order to solve that issue in terms of those zero prices and those negative prices in some markets. Alex, over to you.
Thanks, Sonia. I mean, just to pick up what Nancy's saying, I mean, the reality is that in the near future, China still is going to be the dominant player in modules. And, I think they're still producing 80% of sort of some 11 categories of clean tech at the moment. And I can't see that changing. And the solar industry has benefited from all-time lows in module prices. And I think that's been the big win for the solar sector, considering other headwinds in terms of interest rates and pricing and the availability of corporate PPAs. I think the other thing to pick up on the supply chain point, and particularly modules, is that while prices are coming down, you've also seen improvements in efficiency. You've seen the sort of the rise of top contact technology. I think, BC back contact modules are going to start picking up in production in the next couple of years, and we will benefit from that as well. So we'll have low prices and increases in efficiency, which will help the projects. In terms of the corporate PPA market, it is a challenge for us, as has been picked up a few times. Negative pricing, how you negotiate those PPAs, how you address kind of when you settle, carve outs to availability guarantees, how you define force majeure, how you predict when you're going to hit COD. Those are all challenges when you're negotiating corporate PPAs. And I think that has put a renewed focus on auctions, both for solar and BESS. And we have seen in our own sort of portfolios the positive, it's a given, but when you have a CFD, in your portfolio, let's say in the UK, it has a material impact on returns and kind of the attractiveness of those assets if you're looking to both finance or divest. In terms of other things that I just wanted to pick up on, solar, I think, has benefited from the fact that as we are, let's say, more politically palatable, not just particularly utility scale. It's seen as a very fast deployable technology, which obviously is something the governments like when they've got net zero targets in 2030. And the fact that these projects can now deploy at scale is something that has meant that, if you just look to the UK government sort of CP action plan, the range has 47 gigawatts at the lower end for solar. We are seen as a sort of key backbone of any sort of policy initiatives for the government. So I think we will benefit from that as well. But on our side, hybridization is something that we see as a core part of the business plan, and BESS and wind and sort of expanding our portfolio to accommodate that is something that we see as sort of a natural hedge across the markets.
Yeah, that makes total sense. And, we really need to also support all other renewables technologies, because we need that whole mix in order to be able to deliver the vision we're trying to achieve. But yes, thinking about the speed at which solar can deploy and the versatility of the ways in which solar can deploy, including rooftop solar, of course, which isn't the subject of this webinar, but is also an important part of the vision we're selling, is really important. Also, when getting European governments across the whole continent and the EU in Brussels on board with the vision, and also maintaining that principle that solar is so strategic, so critical to competitiveness of Europe as well, that we should be maintaining the position of free and open and fair and transparent trade in solar between the EU and China and other areas of the world as well. Ruth, I wanted to come back to you, because obviously Europe doesn't just exist in a bubble. We are very much, solar is very much a global commodity, and obviously there's huge change afoot in the US market with the Trump administration coming in January. The Inflation Reduction Act has played a huge role over the last 4 years, and we are interdependent as in terms of a market for financing solar between Europe, the US, and other parts of the world. How do you think we in Europe are going to feel the reverberations of what's happening in US politics and the potential changes coming down the line there? Ruth, over to you.
I think, in short, I think jury is still out. Of course, with Trump being elected, everybody is thinking what is going to happen to IRA. And over the past 2 years, I would say that because we have funds both deploying into US renewables and also European renewables, and European renewables, as you know, each country, the economic model is quite different, even on solar. Some countries historically have been dominated by merchant and full equity. Other market, if there is CFD, it will be CFD or contracted with project finance. So there's a bit of a nuance across different European markets. But if we compare the return across European markets as a whole to US market, because the IRA in the past, you will see US market generating a much higher return on a like-for-like basis compared to European market. And now with the new and incoming government, US government, and then the uncertainty in relation to IRA, a lot of people are having doubts on whether or not in the future we will still see a persistent premium of US projects. And whether or not the IRA will be continued, will be repealed, or will be halted, for lack of a better way to describe it, I think that part, the jury is still out.
Yeah, absolutely. But do you think a lot of the capital that's currently investing in solar over in the States might be coming over to Europe to see if there are opportunities here? And what message would you have, given you have experience of doing both, what message would you have for those kinds of investors if they're thinking of moving over to Europe?
I would say, because I'm from Canada, so I always kept an eye on the North American market. So I think the US and Canadian investors have been in Europe for many years, and the big pension funds and insurance companies have been here for a long period of time, and they have been active investors in the renewables market. What we have seen is maybe increasingly slowly the investors who have historically only been active in the US and now increasingly looking at European market. also because the expectation that the return difference might be narrowed, then the diversification benefits seem a lot stronger than before.
Right, yeah, and indeed, there's potentially even more diversification if they want to go even further afield to other parts of the world. And I'm always struck by how, if you look at the global investment flows for solar in general and renewables in general around the world, 85% of that is going to OECD markets, and very little is going to developing markets around the world. And we need to help investors get more comfortable in these other markets further afield, including some, Eastern European, South and Southeast and Central European markets, where the cost of capital for solar still remains stubbornly high, and we should be seeing those as emerging markets, even within Europe's shores, and looking at how we can really unlock those, in the Balkans, in the Caucasus, Ukraine, of course. If there's ever a big push for build back better in Ukraine, you can certainly argue that solar is more resilient to conflict situations than a new nuclear power plant is. So yeah, all of that is are things to consider. Um, but I'd like to come back to you, if that's okay. You're obviously Bart White from Santander, doing their energy structured finance there, the head of the energy structured finance there at Santander Corporate and Investment Banking. It'd be good to get your perspective on how you see the corporate PPA market. I don't know if you're involved in that, but is that an important driver for you, and how can we expand that to maybe the traditional markets in Western Europe, and see if we can open up that market more in Eastern Europe and in the smaller markets as well, where there may be very little going on. But any thoughts on that, or anything else you've heard in the webinar so far today? And can I just remind can I just remind participants to, if you have any questions you want to ask, feel free to put them in the Q&A box, and we will come to them as soon as possible. Bart, over to you.
I'll reflect on, there was a comment around the political spectrum, so I'll comment on that first, and then come on to talk about the corporate PPA market, which of course is essential in the context of the solar financing moving forward. But just in terms of we have had a political year, a number of elections, and a large part of the world has gone through an election cycle, and very relevant elections over the last 12 months. However, I think in the context of solar, those elections have given us now a new platform in which people know where to invest. So that the uncertainty of the elections has been and gone, and apart from a few geographies which still have a little bit of political complexity, in general, we now know the environment in which we'll be investing into. And I think the helpful point around solar is that solar is not just about decarbonisation, it's critically about decarbonisation, but it's also around low cost of energy, it's around domestic energy, it's energy security. Every country can benefit from solar power generation, and it's about jobs, and it's about supply chain. There's a lot of things around solar which are very accretive to any geography, in any context, in any political spectrum. I think it will get support. So I think actually 2025 will be another record year for solar deployment. I think in Europe we did 60 gigawatts, or just over 60 gigawatts this year, and forecast for next year around 100 or over 100 gigawatts of new solar. So very, very optimistic in terms of these figures, and I think that will just continue to be exponential. It is an abundant and low cost form of energy, and should be exploited to its maximum potential. So I think that's helpful context. Now, in the context of just reflecting on corporate PPAs, so yes, we pivoted from a lot of subsidized financing to financing with either fully merchant transactions or transactions benefiting from corporate PPAs, and the benefit and the stabilization that those bring, certainly to the financing packages. We're starting to see a little bit more commoditization in corporate PPAs. So I know that some law firms have been doing great efforts in trying to standardize elements of the corporate PPA document, because what we don't want is it will create an inertia in new transactions if every transaction has to be a completely different form of legal documentation. Wouldn't it be fabulous if corporate PPAs were as simple as an ISDA, and effectively everyone could effectively form a small term sheet around a common set of principles. It is still a market dominated by hyperscalers. So they are very much the biggest buyers, very relevant buyers. Clearly, they're doing a great job in terms of purchasing power and helping facilitate new investments across the renewable spectrum. So very pro that that theme. But of course, it then means that we're not yet seeing so much more from the broader blue chip environment and space yet. And we all need to do what we can to help encourage access to corporate PPAs to a far broader corporate universe. And part of that's actually with banks to think around and investors to think around a different view around the credit of the counterparty and how to engage with that broader universe. And in terms of where those deals sit in Europe, I think the credit of the counterparty is somewhat more relevant than the underlying jurisdiction. So I think it should be a market which can be embraced in all parts of Europe as well.
Right, so we can take those buyers with us to different markets, and yes, completely agree on that contract standardization point, and it might be interesting to get Alex's input on that as well. But I completely agree with you. We have been in a super election year over the last 12 months, a Superwahljahr, as they say in Germany, super election year, and we have been saying consistently throughout, solar is a vote winner, right? Solar is a vote winner. As you said it, abundant and low cost energy, helping not just businesses, but individual families and households reduce their electricity bills month by month. This is people power at its best, whether that be in the form of local communities, whether that be in the form of rooftops of varying sizes, and we need to use that sort of democratizing aspect of solar as one of our attributes, and making sure that politicians are aware of that and selling that to the general public. And I think most that have taken place this year around the world have been broadly pretty positive for us. If you look at India, the European Parliament elections, the UK, a couple others, they've been broadly pretty positive for us. Obviously, there have been some big upsets. The French elections were completely unexpected, and politics there is not going in the right direction, but I think we can still continue to advocate there. In the US, Trump has declared he is a big fan of solar for all his other attributes, and so who knows what will happen there. But solar is a vote winner in many ways, and so we need to be pushing that. But on point of contract standardization, which is, of course, something that we need to see more of across Europe, indeed across the world. I know the European Federation of Energy Traders and others have been pushing to try and standardize contracts for across the whole sort of project development cycle. There was the Open Solar Contracts Initiative 5 to 10 years ago, which created some global level template contracts. They're now sitting in the International Renewable Energy Agency. That was all part of the Terawatt initiative back in the day. We at the Global Solar Council are definitely looking at whether we can do more work to help standardize contracts around the world at every step of the project development cycle for utility scale, in order to help make it easier to bundle those projects into larger portfolios. But Alex, I'm sure you've seen this firsthand in your work as General Counsel for Lightsource, and it'd be really good to see, to what extent you think this is possible and realistic across all the different legal systems in Europe, but not to mention, Middle East and Africa and the other regions that you're responsible for, and who might be best placed to do this work. Alex.
Thanks, Sonia, and thanks, Bart. It's a really interesting point, and I think the thing to pick up on is that our experiences, I think as Bart touched on, is that you have the very large dominant corporate off-takers in the market who are effectively setting a lot of the precedent in terms of the structure and precedent key terms in the corporate PPAs. And I think that's something that's set to continue. And I think those off-takers are going to drive a lot of the precedent in terms of what is market. I think Bart's touched on something which is really interesting. It's the extent to which the market will open up to other blue chips to enter the market, and I agree with him that I think the banks have a part to play there, as in the generators, because obviously we're as interested in credit as the finance providers as to what acceptable off-taker will look like. there's been some real sort of innovative solutions. So multi-buyer PPAs is something coming into the markets where you see sort of a bundle of off-takers of similar credit and DNA. And we've entered into one of those structures in the last 12 months, which has been very successful. So I think there are ways for the market for the off-takers to work between themselves. I think the generators have a part to play. I think the finance providers have a part to play. But I think the immediate trend will be the dominance still of the large off-takers, particularly in the tech sector, who are driving kind of what is precedent and behind, who really, they have the demand. And so, us as a developer, we're going to sort of move to meet that demand. I think the other point I just wanted to make is the sophistication of the off-takers as well. So trend we've seen is that as a developer and a generator, you shouldn't be seduced into focusing, what I would say, on just core commercial terms. And I think a very appropriate and overdue, and something that we're strongly supportive of, is the scrutiny and the diligence off-takers are taking in the projects themselves. So they want to understand the supply chain. They want to understand your community strategy. They want to know that the projects are being developed appropriately and in best practice, because as off-takers, they are a stakeholder in the overall delivery of the green electron just as much as the original developer. And that's something that we've seen a big shift, which I think is only positive for the industry.
And indeed, in terms of that traceability and that supply chain, the creation of the Solar Stewardship Initiative, the SSI, to try and address some of those concerns, and even more importantly, to create a mechanism for being able to audit specific suppliers and being able to badge them as SSI compliant, compliant with the ESG standards created there, compliant with the traceability standards. That's very much helping, I hope, to assure some of those, both the corporate off-takers who are obviously doing that very deep due diligence, and also your investors, and reassuring their concerns as well. Is that right?
Correct. Yeah. I mean, and Lightsource, we've been a core part of the development of the SSI. It's something that we are very supportive of, the expansion of the scheme, and we're seeing the uptake both on the suppliers and and consumers. I think it's been a fantastic move forward. Another thing I just want to touch on, because it kind of is a key component in how we look to drive financing investment into platforms, is we've been looking at different ways to finance at scale. And if you want to finance at scale, at what point are you seeking to sort of put in place structures that are appropriate for doing so? I think one of the biggest problems of getting to scale is making sure that you have offtake at scale as well. And I think as more of the markets have problems with cannibalization, negative pricing, how you may have a fantastic fleet portfolio of projects, but are you able to match that with offtake at the same scale to benefit from financing at scale? And I think that's probably going to be one of the challenges we face going in 2025, is that there is huge appetite, but we need to make sure the demand on the generation keeps pace with the deployment.
Yeah, and the solution is flexibility, flexibility, flexibility. And indeed, we have a member, DRH, that's starting to look at building flexible modular data centers that can be co-located almost as part of a hybrid project with solar, storage, wind, anything, any other generation assets, where the data center can actually modulate, can flex its own demand up and down in order to solve some of those curtailment problems, some of those grid capacity problems as well. And talking of grid, we've had a question come in from Nigel Chalmers about the grid reforms that are currently going on in the UK, where many of us are based, and how they are potentially creating uncertainty for investors. Particularly, he's referencing the quotas for battery storage projects, and the uncertainty on the date and the location of the grid reforms until the fourth quarter of next year. I don't know who would like to come in on that, maybe Ruth, maybe someone else, but have any of you got first-hand experience of how the various changes to the operation of the grid in the UK is affecting decisions on projects here in the UK?
I can
Alex, you can come in first. Yeah.
I can
Oh,
certainly
sorry.
start.
Ruth,
Sorry.
Ruth, please go ahead. Yeah, Ruth. Yeah.
I can certainly start. Yes, we do see great uncertainty in the UK and also, for example, in Spain. And what that uncertainty looks like is different from year to year, given the incoming regulation. So I would say that everybody is seeing the uncertainty, but how people are dealing with the uncertainty depends on their existing where they are in their investment cycle. So for example, if you already have development positions in the UK, then the uncertainty impacts you in the sense that you already have the projects in the grid connection queue. And almost everybody has projects in the grid connection queue. Then depending on the year and where you are with the incoming regulation, it's the focus has always been try to do everything you can on the project so that your projects will look more ready in the eyes of the DSO and TSO, so that your grid connection dates can be pulled forward compared to some of the other, for example, ghost projects that we're calling it in the queue. Because so in the UK and also in Spain, the grid connection queue is very long. However, one of the central thesis is quite a lot of the projects in the queue actually don't have the financial backing or the expertise sitting behind them in order to actually bring them to realization. And therefore, the projects with institutional investors like us, the expertise and capital to take them all the way should be pulled forward, and the likelihood of success should also reflect in a certain way. And then there's also another way that the great uncertainty can impact the investor is, for example, us in certain markets that we're just looking to getting into the development game. And that, of course, is that how you can do that is also multifaceted in the sense that we can acquire for example, a development platform, or we can acquire a pipeline, which is part of the platform, which already have projects at different stage of the development. However, like Anthony also commented on before, in order to realize the high return from the development, it needs to be, for lack of a more elegant way to describe it, it needs to be a conveyor belt. We need to constantly create new projects because not every project will reach RTB or reach COD. It can be of many challenges. For example, the community challenges that Alex mentioned before, or there could be environmental factors that you only discover partway through the development. And therefore, to achieve consistent return, you need to constantly creating new project. And that one of my key concern in relation to the development and development driving returns in Europe is then tying back to our earlier discussion of the political environment is to the grid connection, the delay and creating new grid connection, because that's really the step one of creating a new project and the driving force behind development. Everybody is talking about development. A few years back, only capital value add investors are looking at development because that's the space that they play at. And now increasingly income investors like us also expanded into the development space. But for the whole industry to succeed and to succeed in the medium term and long term, and not only the short term, we do need new grid connections across different markets in Europe.
Yeah, which is why that global grids target agreed at COP29 Baku of 25 million kilometers of new grid infrastructure worldwide by 2030, potentially 40 million kilometers by 2035 is so important. And it's great to hear your advice, right? Make your project look as less zombie-like as possible.
Yes.
In order to advance in those queues across Europe. Really interesting. Thank you so much for your perspective. We've had another question come in, unless anyone else wants to answer that question specifically on grid. Yes.
I would actually maybe just one comment and then I'll touch on the next question as well, maybe Sonia. Look, I think probably will create in the UK, will create a little bit more uncertainty in the short term, but it probably in the longer term, it would be better. Because if you look at the likes of where Spain, where there's 170 odd gigs of projects are holding grid but may not have planning, reprioritizing the grid back allocation towards the more certain projects, will ultimately be beneficial. And that's what, like in Ireland, you have to have planning before you can apply for grid. So there's happy mediums in the way this works. The Irish system is not perfect either. But maybe just touch on the one question just on the PPAs. We have corporate PPAs. We have like about over 10 corporate PPAs from everybody from the Microsofts down to sort of pharmaceutical and telecommunication companies and so on. Probably my take on that one is probably front of meter, or probably seeing again the vast volume as opposed to behind the meter. But the behind the meter is a very interesting one, and particularly back to our point of hybridization and maximizing efficiency from grid, and how to work with that. So it's definitely emerging, and also where there's opportunity for generators like ourselves maybe to capture a bit more value. So therefore we like it, but it's not mainstream yet, but getting there. So would like to see more of it.
Yeah, that behind the meter options, absolutely. And it's remarkable how also there are things we could potentially learn from the US market, right? The US market has driven a lot of behind the meter using leasing business models that largely haven't taken off in Europe in quite the same way. We need to get the real estate sector, we need to get those mortgage lenders comfortable with those business models, and then we could really expand the amount of behind the meter we can do. We have another question that's come in from Jack Eastwood, and we are running out of time. We've got 4 minutes left, but let's try and take it quickly. So the grid situation is likely to get worse over the next 5 to 10 years, driven by intermittency, driven by a divergence between baseload and pay-as-produced PPAs. How can you overcome these challenges? Bart, would you like to take that question, perhaps?
Yeah, I think my first reflection on that is if we are moving into a world where solar used to be very, very stable in terms of you had a subsidy and the production of solar is more stable than wind. And so the financing technology, or at least that part of the overall equation, was a fixed debt service repayment profile, which is effectively vanilla project finance. Now, in the wind space and in other spaces, we've developed Santander a new financing technology, variable amortization, which amortizes more or less equivalent to the cash flow generated in the period. So if there is a period where you generate more cash, you amortize more. In the period where you generate less cash, you amortize less. We're now doing this financing technology in multi-billion transactions. And I think in the context of solar, if it is going to move into a world where there is a little bit more volatility in cash flow generation because of grid, because of pricing, then we also need to evolve the financing technology to a similar form of financing, which embraces that volatility, but ensures that capital is still available to install new projects. So I think certainly from the financing part of the equation, there is a solution.
Brilliant, thank you, and it's great to hear that you're innovating like that to move with the times. We've left the solar coaster behind, and we're moving into new times. Great, so thank you so much to all our panelists, to all our speakers. They will all be speaking in the event, the live event in February of next year as well. So thank you to Anthony Doherty, the Chief Investment Officer at NTR. Thank you to Ruth Lai from Infrared Capital Partners, to Bart White, who just spoke, obviously, Head of Energy Structured Finance at Santander, and to Alex D'Souza from Lightsource. And thank you for joining us in this webinar. We will be reconvening on the 4th and 5th of February in London next year for Solar Finance and Investment Europe. It's the 12th time we're having this summit, so it's really exciting to be coming together again. Please do, and I say this as a sort of independent not-for-profit association, it really is a good event, so do get yourself a ticket if you haven't got one already. We'll be covering all of these topics and more in a much more detailed way. It's all organized and curated by the lovely Solar Media team, and really it's designed to be a place not just to learn but also to network, right? To network with all the deal makers and decision makers that you need to be speaking to, not just in the UK but across the whole of Europe. You can get 20% off tickets by using the discount code webinar20. That's webinar20, so just use that if you want to get a healthy discount off your tickets, and we will certainly all be there, and we look forward to seeing you as well. Thanks very much. So my name was Sonia Dunlop. I'm the CEO of the Global Solar Council. We're the World Solar PV Industry Association, and it was a pleasure to moderate this webinar today and to talk about all these important issues with everyone on the panel. So I do wish you all a very Merry Christmas, however you celebrate. Thanks for all of your hard work. You've collectively across the world got to 600 gigawatts this year, a huge achievement, 2 terawatts of total installed capacity. I think we can all give ourselves a pat on the back. Well done. Enjoy a well-earned Christmas or Chinese New Year or whatever else you might be celebrating soon, and see you again in the new year, hopefully in February in London for Solar Finance and Investment Europe. Thank you very much, everyone, and see you soon. Bye.